Hi, everybody. Rick James here, owner of Environmental Mold Solutions. I've met many of you in the past, and we appreciate all your support and reaching out to us anytime there's a mold growth issue or water damage in any property. One thing I always like to point out, my company does remediation. We do not do testing. It's a big time conflict of interest. Other states, as you can see there, they don't allow it. You should really be careful. Make sure you use a company who does remediation only and then a third-party testing company. The most important thing to remember is mold cannot grow without moisture. So anytime there's unwanted moisture, that's when you're going to get mold growth. So some of the biggest issues that allow for mold growth in basements and crawl spaces, if there's poor drainage, as you see in the photo here, that's going to lead to water intrusion. Sometimes in crawl spaces, they have vents allowing for outside air in. Every basement and crawl space is inherently a damp environment, so you got to keep the relative humidity below 50%, run a dehumidifier. Vapor barriers, I've been in thousands of crawl spaces. They're actually detrimental. You really don't want these. I'm going through fairly quickly. If anybody has any questions, you can reach out to me. Mold won't grow on unpainted foundation walls, but it can grow on painted walls. That's efflorescence you see there. But anytime you put a product on the foundation walls, mold can then grow on it. As you see here, if you're ever walking around a property that you're going to start listing or potential buyers are looking at, and you see water staining on baseboard molding trim, that means there was a water occurrence. Sometimes there may not be real visible signs. So here is one job we did, the corner. There was a little bit of damage, but when you look behind the walls, there was significant mold growth back there. And mold is not always dark in color. This is on a basement. You can see it's a more of a white fluffy mold. Same thing here. If you ever walk in and see a well tank, that's because the relative humidity is not kept low enough, or a water softener. Bathrooms are problematic areas. We do a lot of bathrooms, probably about a half a dozen a week. That's what it looks like when we're done. Again, you need to control the moisture. Anytime there's water intrusion, we handle that. We dry materials out even before mold growth occurs. We do a lot of attics. So if you ever go up there and you see dark growth, that's the before, and that's what it looks like after. Again, it's due to poor ventilation. It's all about controlling unwanted moisture. Basements, crawl spaces run a dehumidifier. Attics need ventilation. Bathrooms need exhaust fan. Our guarantee, the product we use has metal in it. Mold will not grow on metal. No other company in the region uses it. So even if there is unwanted moisture, our product will prevent mold growth in the future. Anybody has any property they're dealing with, please give us a call. That's our number. Easy way to remember. It's 866-368-6653. I will happily come out and take a look. And I thank you all for having me today.
Thanks, Rick. I'd like to introduce Yury he is the owner of Innovative Mortgage Brokers. He has been in the mortgage business for more than 15 years, helping clients in PA and Florida with mortgages on residential properties. Yury received his associate degree from Bucks and then proceeded to get his undergraduate and MBA from Temple University. He originally grew up in Northeast Philadelphia and recently moved to Doylestown with his wife, Rita. 19-month-old daughter, Arabelle, and an 11-year-old lab, Mishka. Yury is also a real estate investor and has done both long-term holds as well as renovated flipped properties. I'd like to introduce his program. It's called Unlock More Deals, Understanding Non-Qualified Mortgages for Realtors. Yury, take it away and feel free to unmute to ask questions of him.
Thank you so much. Thank you everyone for joining today. Let's start. And please stop me anytime if anybody has any questions. Put it in the chat. And I definitely want to have this a conversational hour. So stop me anytime. So the topic today is Unlock More Deals, Understanding Non-Qualified Mortgages for Realtors. I'm going to just basically cover a little bit about non-QM mortgages, what type of clients those products are good for, why non-QM is a good product for real estate agents to know. So first, I'm going to tell you a little bit about me, who I am, and why I'm able to talk about non-QM. a little bit about my experience. In general, the type of loans that are available out there. Then we obviously cover the non-QM loans, followed by why do non-QM loans matter? And then who are the non-QM loans for? I'm going to discuss a couple of the key features of the non-QM loans, common myths, and then how to identify borrowers for these type of loans. And again, please let's have this a conversational hour. So if anybody has any questions, you're more than welcome to ask at any time. So a little bit about me. Currently, I live in Doylestown. I've lived here for about a year and a half. I'm married to my wife for about 9 years, and I have a daughter who's a little over 2 years old, and I just had a second daughter about a month and a half ago. I have a dog, Mishka. He's my 12-year-old lab. And in terms of professional, I've been in the mortgage business combined for over 15 years. I'm also a certified credit specialist. I am currently a mortgage broker licensed in 2 states, Pennsylvania and Florida. And as a mortgage broker, we currently work with about 30 different lenders. So because of that, we have access pretty much to all residential products that are out there. Approximately 25 to 30% of my business currently is in the non-QM space. And during my 15 years, I've had experience of working with both non-QM loans as well as subprime loans that some people refer to as the non-QM. So I would definitely be more than happy to describe some of the differences between the two. So first, let's talk about the type of loans. So in general, this is the 5 main types of residential mortgages. You have the FHA, conventional VA, USDA, and non-QM. Now, the first 4 are kind of easy in terms of lending because they have guidelines that are set by those respective agencies, right? So FHA sets guidelines. Conventional, the guidelines are set by either Fannie Mae or Freddie Mac. VA says theirs, USDA says theirs. The difference is that on the non-QM side, there is no organization that sets non-QM loans. So because of that, those products could vary significantly from lender to lender. Now, so non-QM loans. What are non-QM loans? Well, technically, there really is no definition of what a non-QM loan is. There is a definition for a qualified mortgage, for a QM loan. And then basically loans that don't meet the qualified mortgage requirements are automatically non-QM loans, right? And this was said by CFBP. Now there's some challenges in the CFBP, so we'll see what happens down the road. It was developed right after the Dodd-Frank Act, after the whole 2008 issues. And the point of the non-QM loans is that it has flexibility. The guidelines, the underwriting guidelines are less rigid than the ones on traditional loans, FHA conventional. So what a QM really means is it's a loan with less risky features and protections that make it more likely that a borrower will be able to afford the loan. A lender must make good faith effort to determine that a borrower has the ability to repay the mortgage before providing the loan, right? Which is called the ability to repay the loan. Now, the difference on the non-QM side is that the borrowers still have to provide the ability to repay the loan, to ability to repay the mortgage, but there could be other documentation that's used compared to the traditional one. So one statistic is that currently 1 out of 20 mortgages are non-QM in 2024, so last year. So that's 5%, right? Non-QM mortgages are type of loans that cannot be purchased by the government-sponsored enterprises or federal government, which is Fannie, Freddie, FHA. These loans excel at meeting the needs of borrowers whose financial situations don't align with conforming lending requirements. These programs not only identify the gaps left by traditional loans, but also offer practical solutions tailored to unique circumstances. And then as the mortgage industry continues to change, non-qualified mortgages are emerging. And in 24, it was over 5% compared to in 2020, it was a little bit below 3% for the total non-QM loans. So over the last 5-6 years, they have grown significantly and they are expected to keep growing. Now, biggest question, why does this really matter to real estate agents? So, number one reason, it expands your buyer pool. Now you can help more clients in terms of the purchase. Non-QM product, it's not a primary product for a borrower. It's a backup option, I feel like. So if a borrower qualifies for a regular conventional FHA loan, that's great. However, if a borrower, for whatever reason, doesn't qualify for a regular conventional or FHA loan, a non-QM loan is a great backup option, at least as a temporary Band-Aid solution. Also competitive edge in terms of offering non-QM products. You could specialize towards investors, towards self-employed entrepreneurs, things like that. And faster deals. Right now, as the non-QM space is evolving over the last 5-7 years, more and more lenders are getting into this space. More and more technology is being utilized in this space. So the process from beginning to end is shorter. Now, right here, the non-QM space is the fastest growing segment of the US private label residential mortgage-backed securities. The industry experts are projecting that in 2025, it's going to be approximately about 100 billion out of the total 2 billion. I'm sorry, out of the total 2 trillion. They're expecting to be approximately 100 billion, which is about 5%. Investor participation and capital investment is increasing in this space. Investors are getting more and more into it in terms of the pension funds, in terms of the insurers. So investors feel like this is a great opportunity for them to make more profits. Now, here is the biggest 3 primary reasons in 2024 of why borrowers got into non-QM loans compared to conventional or FHA loans. So number one is limited or alternative documentation. 62% out of all the non-QM loans were for limited or alternative documentation. 26% was due to DTI ratios, and that's because on a conventional side, DTI ratios need to be around 43%. There is some wiggle room where conventional allows up to 50%, but there does need to be some extenuating circumstances, good assets, things like that. It doesn't automatically allow up to 50%. And then also people chose interest-only loans. So approximately 17% went with non-QM because of the interest-only. An interest-only product is only available in non-QM. All 3 of these options are only available on the non-QM side. So typical non-QM borrowers. The biggest ones are self-employed individuals. Every single day, I speak with borrowers that are self-employed, and they're telling me how much money they made, and they made hundreds of thousands of dollars last year, blah, blah, blah. But the thing is that once I'm actually reviewing their tax returns, we realized that the number they told me was the gross figure. It wasn't the net figure. The net figure is obviously always smaller. And the question is, will that net figure be enough for the DTI calculations? A lot of the times on self-employed individuals, unfortunately, it's not. The reason for that is because, everybody who's self-employed goes to an accountant and they try to minimize the tax expense. Well, the problem is that it kind of double-edged sword because that's what the underwriter is looking at. So when a borrower is going to buy a conventional Fannie Mae, Freddie Mac type of a loan, or if they're going for an FHA loan and they're self-employed, they're entrepreneur, they own a business, 1099, whatever it is, the underwriter is going to ask for either 1 or 2 years of tax returns. And a lot of those times when people are self-employed, unfortunately, those numbers don't match. So For self-employed individuals on the non-QM side, there's a couple of different options. Option number one is to go with a bank statement loan. So what the lenders would do is instead of looking at the borrower's 1 or 2 years of tax returns and calculating income based on the tax returns, they look at the borrower's last either 12 or 24 months of bank statements, and they calculate the average monthly deposits, and they use that calculation for the DTI purposes. So a lot of the times, based on my experience, the tax returns don't accurately reflect the income of the business for various reasons. And that's where a bank statement loan could come in as a valid option, because self-employed individuals have much larger amounts going through their bank statements, obviously, that are being reflected on the tax returns. So a bank statement is one option for those individuals. Profit and loss statement is another option. So when a borrower is self-employed, instead of using tax returns, instead of using bank statements, there are lenders out there that would just use the profit and loss. Now, obviously, the profit and loss statement needs to be prepared by a third party. So it needs to be either an enrolled agent or a CPA, accountant, somebody who's licensed to file tax returns with IRS. And that profit and loss could be used in lieu of tax returns, in lieu of bank statements. For real estate investors, the biggest non-QM product I'm sure many of you heard of is the DSCR loan, debt service coverage ratio loan. That's where when a borrower is buying an investment property, the underwriter is not concerned with the borrower's income at all. They're also not concerned with the borrower's expenses. All that the underwriter wants to see is they want to see the rental income from the property, either lease or market rent, whichever is lower, and they compare it to the expenses, which are the property, the new mortgage, plus taxes, plus insurance. And as long as that ratio works, they're more than willing to lend to borrowers on those type of products. And again, you don't need W-2s, you don't need pay stubs, tax returns, nothing. It's just debt service coverage ratio. So the underwriter only looks at the income from the property and then only the expenses, which are the new mortgage, taxes, and insurance. Recent job changers are great borrowers for non-QM type of products, because a lot of the times, depending on what the employee is doing, if they're switching jobs, there could be additional documentation, additional history that would be required for a conventional loan or FHA loan compared to non-QM loan. So people that switch from W-2s to 1099s or switch industries, jobs, those could be potentially good clients for non-QM. Credit challenge buyers. Now, this is important to know because non-QM does not target individuals with bad credit history. So if somebody has a credit score in the 500s and the low 600s, they're not a good candidate for a non-QM product, because non-QM product, it's a riskier product for the lender, obviously, because they look at bank statements, profit and loss, as opposed to what the traditional products look at, tax returns. So because of that, they do want the underwriters, the lenders want the borrowers to have good credit. Now, what they allow is they allow recent credit events, negative credit events. So if somebody had a bankruptcy recently, if somebody had a judgment recently, foreclosure, things like that, on a conventional loan and an FHA loan, there's a much longer waiting period that the borrower needs to wait, as opposed to on a non-QM side. Those waiting periods are a lot shorter. But again, they do need to have somewhat of good credit history. So if somebody just filed for foreclosure, they're not paying any of their bills, and their credit score is in the 400s, they're not a good candidate for a non-QM. But if somebody that missed a couple payments, but they do overall have enough good accounts and positive history, positive score, good score, then they could be a good candidate. And then finally, we have the foreign nationals. So somebody who's a non-resident, they're looking to buy an investment property in America, that could be a good candidate. And also retirees. So, and when it comes to retirees, a lot of the times their income, their monthly income is small, right? So they could have a lot of liquid assets, 401k, they could have stocks, bonds, cash in their accounts, but their income might be very little. So because of that, there's non-QM products that basically look at your assets, how much assets you have, and calculate your income based on your liquid assets as opposed to regular, pension, social security, things like that. So key non-QM loan features, right? The first one is obviously we mentioned alternative income documentation. We can use, instead of using the tax returns, W-2s, we're using bank statements. We can use assets for the asset depletion loans. We can use profit and loss statement. More flexible requirements where there is a shorter waiting period for the recent credit events, negative credit events. Sometimes the debt to income ratio on non-QM loans is a little bit higher compared to conventional. And then also, when it comes to non-QM, borrowers have an option of doing it an interest-only loan. They can do a 40-year option. So anytime you hear a 40-year mortgage, that's always a non-QM product. And also, non-QM loans are able to go in an entity's name. So if somebody wants to purchase a property, put a deed in an LLC in order to minimize their risk, you can absolutely do that with non-QM loans. On the conventional loan side, Fannie and Freddie don't allow you to have the deed in an LLC. However, what some people do is they just buy it on a personal name and then transfer it to an LLC later. That could be risky. That could not be risky. But one thing to remember is when it comes to non-QM loans and deeds is that the deed is going to be in the name of an LLC, but the mortgage is going to be in the name of an individual owner. If there's multiple owners, then multiple, sometimes depending on the lender, sometimes all owners of the entity need to go in the mortgage. Sometimes only at least one person needs to go in the mortgage. But again, the mortgage is in an individual's name. It's just the deed is going to be in an entity. So it protects, from the conversation I heard, it could possibly protect the owner, the landlord. Now, credit and quality of non-QM loans, right? Because we're mentioning credit events, things like that. So a lot of people could possibly, and because a lot of people compare it to subprime loans, people could think that this is very, very risky. However, in 2024, the average credit score for a non-QM borrower is 776, which is only a couple points below an average conventional borrower, and higher than a government loan, which is FHA or USDA, by at 699, which is the average score for government loans. So the credit score, again, is a factor that the lenders look at, and you see here that an average score is very close to the regular conventional loan. And just one thing, score, what's the point of the score? Well, that's what the lenders look at because that's that's the most likability of default in the next 90 days. So borrowers with higher credit scores have less likability of default in the next 90 days, and borrowers with lower scores obviously are more likely to default. Loan to value ratios are also very similar to QM products. So approximate average loan to value is 75%, while the government is at 97%. Delinquency rates, they are a little bit higher, obviously because of the alternative documentation. However, they are much, much lower when it comes to government loans such as FHA and USDA. Common myths. So the first one is these loans are like subprime loans. They're nothing like subprime loans. So I've dealt with subprime loans back in the early 2000s. I was in the business. I'm very familiar with non-QM loans. They're they're totally different, right? After the 2008 collapse, lenders, underwriters, the industry learned their lessons. So because of that, yes, these loans are a little more riskier. They do obviously come with a little bit of a higher interest rate. However, they're nothing like subprime. You know, I remember doing 100% financing for borrowers with 500 credit scores with subprime back in the day. These require good credit, and they are less riskier. Second myth is that they come with excessively high interest rates, and I got some numbers to talk about that as well. And then the final one is that they're complicated and they take longer to close. So that used to be true because it's a newer product, right? Non-QM loans came out approximately 5, 7 years ago. During COVID, during 2020, a lot of lenders actually went out of business and stopped doing non-QM. So for approximately the year, maybe 2 years, non-QM wasn't accessible. Then it came back. So compared to other products out there, it is extremely recent product. And the lenders are constantly improving. They're improving their services. They're improving their technology. So yes, 5 years ago, you know, it would have taken a lot longer to close a non-QM loan compared to a conventional or FHA. Now the timeline is pretty much the same. Here are some of the numbers that I wanted to talk about. So yesterday, this was a pricing that I did yesterday. This is a borrower with a 720 credit score. They're purchasing a $500,000 investment property with 30% down. So their loan amount is 350,000, and they have the 720 credit score. The difference between a conventional loan and a non-QM loan in this particular case is almost 1%. On the non-QM loan, the borrower was looking at about 7.625 interest rate, as opposed to on a conventional, he would be at 6.875. So it's approximately 1% higher on a non-conventional loan. So that's why I'm saying if a borrower can qualify for a conventional loan, by all means, conventional loan is better. However, if a borrower can't qualify, this is the backup because of the fact that this borrower is paying an extra $180 a month in terms of the mortgage, right? First of all, obviously going conventional is not an option, but even if he could, he's paying $180. Now, over 5-year period, the difference is about $10,000. Okay, 148 as opposed to 138. However, this is an approximate appreciation. Now, obviously, you know, nobody knows what the appreciation is going to be in the next years. It's all a guessing game. It's all, you know, just guessing the numbers. But I think we can all agree that in our area, an average annual appreciation is going to be at least 4% or more, right? So this is a very conservative figure based on historical. So a property that's being purchased for $500,000 is going to be worth in 5 years approximately 600,000. So there's an increase of about 100,000 in equity, and the interest rate extra cost is about $10,000 during that period. So the net benefit, the net difference, is still $90,000. So it's better to go with a non-QM loan as opposed to not being able to purchase the property altogether and miss out on all this appreciation, you know, pay down of the loan and everything like that. Now, how to identify potential non-QM candidates? So first, it's ask about employment and income sources. Anybody who's an entrepreneur, freelancer, self-employed, irregular cash flow, they would be a good candidate for a non-QM loan. Now, again, a non-QM loan for a borrower that's purchasing an investment property, most of the time they're all going with a non-QM loan. For a borrower who's purchasing a primary residence, if they can't go with a non-QM, they can, if they can't go with a conventional, they can get a non-QM could be a temporary Band-Aid. So they get a non-QM loan, they live in there a couple of years, they work on their tax returns, they work on their income, profit, things like that. A couple of years later, boom, their income looks better, their DTI works, they can always refinance into a conventional or an FHA loan. Credit history, that would be another good borrower that recently had bankruptcies, judgments, things like that. Um, rental properties. Most of the time when borrowers are buying rental properties, most of the time it's with a DSCR loan because a lot of the times, their income, their tax returns is not good enough to qualify for a regular conventional loan. So DSCR is always an option, or if they're trying to do it with an LLC. And then also international buyers that have ITIN or things like that that might not have a social security number. Now, I wanted to also talk a little bit about some of the past clients that I've helped with non-QM loans and kind of exactly why they chose to go the non-QM route versus another route. So there was a borrower that was purchasing an investment property, and he had to go with a DSCR loan. So we were doing non-QM DSCR loan. During the mortgage process, the client loses his job. He gets laid off. And this is approximately 2 weeks before closing. So obviously on a conventional end, on an FHA, lenders wouldn't even consider it a loan. Here on a DSCR, on the non-QM side, it didn't even matter the fact that the borrower lost his job because his job wasn't a factor in any of the calculations. The lender didn't even care where the borrower worked. So the fact that he lost the job, it was totally fine with an underwriter. I had parents in Florida that wanted to buy a property for their son. So their son lives down in Florida, the parents live in Maryland, and they wanted to buy a property for their son to live in because they were tired of paying rent. But unfortunately, the father was on Social Security pension. He was an older gentleman. The mother was self-employed piano teacher, so she was reporting very limited income. So they decided to go with a DSCR loan because it was an investment property for them in Florida, and they bought it for their son and allowed their son to live in their property. Again, their personal income, personal expenses was not a factor at all. Had a borrower recently that went to a local credit union. He got pre-approved by a local bank with his tax return. So this borrower was self-employed. He provided his tax returns and he got a pre-approval. The problem is that then when he went under contract, he already filed new tax returns that didn't show enough income. So he filed the tax returns after the underwriter approved them and after he went under contract. So because of that, obviously, when the underwriter received copies of the new tax returns, it didn't work. In our case, we went with 12-month bank statements, and this borrower was a truck driver. So most of their, even though their profit is not correctly affected, most of their cash obviously goes through the bank statements. And the deposits were large enough in order to help this borrower purchase a primary residence and not have to worry about anything with tax returns. I had a borrower a couple months ago. They wanted to buy an investment property. So there was a great deal where they live. There was two duplexes. This was in Philadelphia. There was two duplexes side by side, a block away from where the borrower lives that were for sale. And the borrower really wanted to buy both of those duplexes. They were self-employed. They purchased it with DSCR loans. so it wasn't a problem. The only thing that they obviously needed to come up with was the down payment. So in this particular case, I think they did either 25 or 30%, and they qualified and they bought 2 duplexes. They put it in an LLC, and I was actually really happy and proud of this. This was borrowers that came to America less than 10 years ago, so it was immigrants, and they came to America, started with nothing, and they ended up being self-employed. They operated a successful local business and were able to purchase 2 duplexes at approximately $350,000 each. They were able to come up with about 25-30% plus closing costs after only being in America 10 years and working their butts off. And that's just very impressive. So that's the biggest thing is, again, non-QM, it's a great product as a backup option, right? That's what I want to stress. This is not a primary product that the borrower should apply for and say, oh, I want a non-QM loan. But if they can't qualify for a regular conventional loan, if they can't qualify for an FHA loan, I personally believe that as long as the numbers work, it's better to go the non-QM route as opposed to not being able to get the property altogether. Now, the key is, again, especially on investment properties, because non-QM is a lot of the times the DSCR loan. So on the investment properties, the borrowers just need to, pull out an Excel spreadsheet and make sure that the numbers work. As long as the income is there, as long as you're making those mortgage payments at a little bit of a higher interest rate, but as long as the numbers work for them as an investor, it's definitely a great product to explore, as opposed to not getting but not buying a property altogether. So here, basically non-QM loans are designed to help well-qualified buyers with non-traditional income, credit, or asset situations. Again, it has to be well-qualified buyers. People bad scores, no income. On a non-QM loan, borrowers need to put larger down payments as opposed to conventional or FHA. So on an investment property, borrowers need to put usually about 20% or more. I always recommend to do about 25 to 30% in order to get better rates. And on primary residence, depending on the credit score, usually borrowers have to put about 10 to 20% down for this to qualify. But again, as long as they can qualify, as long as they can't qualify for other products, this is a great product. I believe agents should definitely embrace non-QM options. It's an absolutely great option to have in your toolbox. I've been working with these products, like I said, for years, and they're evolving, just like everything else. And next steps is basically just to collaborate. So a lot of local lenders don't offer non-QM. So usually you would have to go through either bigger lenders or local brokers. So if anybody has any questions, my contact information is right there on the screen. Reach out anytime. As a mortgage broker, we work with all types of residential products. So yeah.
Hey, there are two questions in the chat. Scott, would you like to ask your questions of him?
Yeah, sure. I got a couple. I mean, if we got a little bit of time.
Good for you. Yeah.
The first one was about the 40-year loan product. Could you talk about that a little bit more?
Sure. So it's basically just a regular product. It's just the difference is that instead of having a 30-year amortization, it has a 40-year amortization.
Is that 40-year fixed?
Yeah, yeah. They're 40-year fixed.
Gotcha. Okay, cool.
Now also, because it's a non-QM, the rates are a little bit higher. So one thing to keep in mind, but yeah, it's a regular 40-year product.
Gotcha. And for say you have a candidate that comes in and their credit's a little too low for any of these non-QM products, do you do any type of like credit repair programs for them or offer referrals to someone or?
Um, I can, because I've been doing this and because I'm, certified and things like that, I can help people. No, I don't do any kind of credit repair myself. Um, I don't know, depending on the number of issues that the borrower has, I don't know if they really need credit repair or not. If it's just a few things, people could probably deal with that on their own. The problem is that, when it comes to credit repair, sometimes company promise you the world, you pay, and then nothing gets removed, and in reality, if those delinquencies are really supposed to be there, um, it's difficult to get them removed, or they might come back eventually. So yeah, I could have a conversation with a borrower, let them know, look at their credit, let them know what needs to be done, and just give them suggestions, and they could do it themselves at no charge.
Gotcha. And see if I can phrase this right. So for the DSCR loan, I know for larger properties, say like more than 4 units, it's typically a commercial loan. Does that still apply to DSCR loans? Like for commercial loans, it's usually only for 5 or 7 years. And then is DSCR loans always 30-year fixed? There's like a limit to the size of the
So,
rental property?
so first of all, there's two differences. So you have residential properties and you have commercial properties. So residential properties is anything that's 1 through 4 units. Commercial properties is well, one residential properties is either 1 through 4 units, and obviously all of them have to be residential. On a commercial side, it's 5 units and above, or anything that's commercial. So that's on the property type. Then you also have, in terms of the loans, right? You have what some people call as commercial loans or business purpose loans. So those could be referred to as DSCR loans. They could be referred to, multiple properties. So it's kind of mixed in, but sometimes people refer to commercial loans even though it's commercial property. Does that make sense?
Got it. Yeah, I think I got it.
So, and on the DSCR, the DSCR is usually calculated on the 1 through 4. There are lenders that go more units. And
Gotcha. Okay. And then I got one last one, which might be a loaded question. So do you have any thoughts about, I've been hearing about the Fannie Mae and Freddie Mac going public recently. I don't know if that actually happens, how soon that would be. Do you know how that could affect conventional loans? Do you see them maybe getting a little bit more lax with their underwriting to make it more, I don't know, easier for borrowers?
um, I mean, getting lax with underwriting is probably not a good thing, right? I mean, underwriting is not really that complicated, right? It's if you're a first-time home buyer, you go FHA loan, 580 and above credit score, you do 3.5% down. Conventional loan, first-time home buyers can do 3% down. Um, Underwriting is, it's basically with like guidelines. So I'm not sure if they need to be going more relaxed than they are, because that could possibly eventually lead us to the same thing we were at in 2008. The issue, though, to tie that in, is that there are some concerns with, CFBP being laid off and things like that. And when, like, for me, I'm a small broker, so I can be regulated by the Department of Banking, right? But when companies are big national companies, lenders, it's very hard to have them regulated by all the states' Department of Bankings. That's where kind of CFBP came in to help the consumers, protect the consumers. And now I think the question is of, what's really going to happen and where those responsibilities are going to be transferred. So I think because of that, it could get lax, and that could cause a little more confusion, compared to, Fannie Mae, Freddie Mac. Um, Also, from what I've been reading, it does take a while to privatize them. It's all a guessing game. I try not to speculate too much, just because, today you're thinking one thing, and then something happens on the news tomorrow and your thoughts are totally different. So, I try not to like worry about where the rates are going to be in a couple months. I'm kind of trying to, concentrate on like where they're going to be and kind of go from there. But yeah, I mean, with guidelines, I personally don't believe that, Fannie, Freddie, FHA, they do want people to become homeowners. Banks, underwriters, nobody's there to deny the loans. Underwriters don't get paid for denying the loans, right? They get paid for following the guidelines. So yeah.
Gotcha. Cool. That's all I got. Thank you.
Sure.
Eric, are you on?
Yeah, I'm here. Thank you.
Sure.
Hi, I have two questions. One is a buyer's agent and one is a seller's agent. So, as a buyer's agent, if I was to propose this to a client, how much extra time might it take for to get them qualified to get a pre-approval for any of these products in general? In general, like is it additional time than a traditional loan, or is it how would you define that?
Um, yes, it would take a little bit of time, but not too much. I mean, it all depends on, which program you're doing. If you're doing bank statements, there would need to be a computer system underwriter to kind of look at the bank statements, because what they do is on a 12, 24-month bank statement, they don't just take all the deposits, average them out, and use that number. They also look at the irregularities of the deposits. So, for example, a borrower has a weird deposit of $50,000 or whatever, it could be minused out. So there is a system that looks at all that. And in terms of the timeline, I would probably say, an extra maybe 24 to 48 hours max.
Oh, not
Depending.
weeks difference. It's
No, no,
like a
no,
day or
because
two difference.
the
Okay.
thing is that a lot of people, so one thing I forgot to mention, so,
Uh-huh.
a lot of people hear no doc loans. Well, I don't know any lender that's going to give you a loan based on no documents, right? Everybody wants some kind of document. So with these type of loans, it's all the same thing as a regular mortgage. So the process is very, very similar. It's just the only difference is what are you using for income? So if you're using the bank statements as income, it might take a little bit of time to calculate that. On a DSCR calculation, the pre-approval really doesn't even matter on an investment property because we use the DSCR. So normally, when I provide a pre-approval for a borrower on an investment property DSCR, I just tell them, hey, you got to make sure that the DSCR calculation works, and you got to have whatever amount of money down, 20, 30% based on their credit score. And that's it, because I don't need to look at, obviously I would look at the credit, but I don't need to look at their income because their income is irrelevant. So it all depends on the product, but for DSCR loans, those are really quickly approved.
Okay. And thank you. And now as a seller's agent, if I'm receiving offers, and let's say I want to say from the perspective of a seller, if I receive these offers and we receive these non-QM offers, what kind of credibility packet could be provided so so an offer would be considered a strong offer versus like a traditional lender? In other words, if here I am as a listing agent and I need to provide assurance that, hey, this offer is a pretty good offer, although you've never heard of a non-QM, can will the buyer be able to provide, or will the lender be able to provide any credibility packet to say this is why you could trust us, and here's some information?
Um, I mean, the
Because
problem is,
I mean I could tell
I
you just from a recent experience. I as a listing agent, I received one of my offers I received from a commercial lender without much information, and it just presented itself as a as a very suspect
right.
offer. But
So
anyway, I just wanted to give you my perspective.
yeah, no, I mean, I totally agree with you, and I see, absolutely see your point, but No, but at the same time, you know, anytime that you get a pre-approval for FHA, conventional things like that, there is no guarantee, right? I mean, a lot of the times a borrower can literally go online to one of the lenders and just plug in that, you know, they're self-employed, they make $500,000, blah, 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 and they'll get a pre-approval, right? So I understand your concern of what you're saying in terms of the validity, but in general, I'm very hesitant of all pre-approvals. That's why I think that, you know, probably you would need to look at, you know, maybe who it's from rather than the product itself, right? Um, that's just my opinion because again, I've seen some of the pre-approvals and the stories that I've heard. I mean, you know, working with big name lenders, and then a couple nights before closing, things don't fall through. And I'm sure you've heard of those bad stories too. And you know, none of those stories have anything to do with non-QM. So you got to be wary of all of those pre-approvals, and just kind of look at the validity of the person, the company. But the product, I'm not sure if the product really matters.
Right. Yeah. And so I now taking that same question, and as a buyer's agent, I'm working with a client, and here I present an offer. Again, I'm sort of stuck in the same situation that I could say, look, this is a innovative mortgage brokers, closes these loans all the time. They'll close the loan. In other words, I just want to be able to have some sort of quick reference that I could say, this is why they'll be able to close the loan.
Yeah, that's basically exactly what it is. Just, you know, looking up and you know, any pre-approval that you have, I mean, you know, probably like looking up who it's from because again, you know, in any kind of business, there's different people and it's just that there's so many horror stories and you know, like one of
Right.
the
I just want to, I don't want, I want to eliminate the doubts of non-QM loans. Non-QM loans aren't as prevalent, obviously, than conventional loans. So when a realtor receives information like that, he might look at it with a wince saying, I've never heard of these non-QM loans, or these non-QM loans aren't that good, etc. I'm just saying, hey, it would be helpful to have some sort of package instead of me having to sell it as a buyer's agent.
Yeah, so normally, I mean, normally, you know, if I'm the loan officer, I can have a conversation with, you know, the listing agent or whatever, put in a good word for the borrower, explain to them, you know, what's been reviewed, the whole situation, haven't really had problems. Sometimes maybe, you know, on an offers, on the pre-approvals, maybe just putting in 30-year fixed. I don't know if, you know, the product really kind of matters or not. So yeah, but, you know, on the other hand, again, it's people ask me how long does the regular pre-approval last, and my answer is always as long as nothing changes, right? Because I've had situation you give a pre-approval tomorrow, the buyer loses job. So yeah.
Okay.
But in terms of the packet, to answer your question for the packet, it's difficult because like I said in the beginning, where you know conventional loans, government loans, they're set by certain agencies. Here, these loans are set by investors. So the requirements could vary significantly from one lender to another. So a lot of the times when I have an issue with a non-QM loan, I can call a different lender, run this issue past them, see if they're able to do it. If not, go on to the next lender. You know, so if one lender denies this product or this borrower, it doesn't necessarily mean the other lenders are going to deny it as well. Bank statements, I've had different lenders calculate bank statements differently. You know, you provide 12 months of bank statements to one lender, they run it through their system. You provide it to a different lender, they run it through their system. Numbers come out differently.
All right. Anyone else have any questions they'd like to ask? Okay.